All right, so John actually has two different positions mixed with this. First is 3,000 shares of AMD, and he's got a profit of $2,000 so far. Now he also owns a January 2020 $12 call for a cost of $3.75. Now, from what he believes, AMD could hit 15 or higher, but has been extended, and perhaps it's time for a pullback. What could be some of the option strategies one could use in this case? Okay, so what is the situation? We have two long positions, a long call and long stock, and now we're worried about a pullback. Okay, well, let's go over to Power Options very quickly. Let's take a look at the two positions in the portfolio that we have put in there for John. To take a look at these two first. There we go. Okay, so let's go ahead and go over to screen one. And what we're looking at here, of course, is just the basic structure of a trial account on Power Options. So those of you that are just getting started, I encourage you, of course, to take advantage of the 4 steps that are listed there. So you can schedule the free coaching session and so forth. Go through the free flash tutorials, access the free webinars we have, the live webinars and the recorded webinars, and of course get the quick start guide. One of the first things you should do when you start out at Power Options is input your positions into the portfolio to help you with your tracking and your management. So I'm going to go over to Portfolio right now. Normally I'd click Setup. We could enter the positions manually, and we would just create a portfolio, but we already went ahead and did that before the webinar started. So I'm going to Portfolios to see my open positions. First, we have the 3,000 shares of long stock on AMD, $13.59, and right now we have a cost basis of $14.73. So there's that $2,300 profit that John was alluding to. Okay, and of course here's the long call where I only put in one contract, but he says he had a $450 profit, so he's probably got maybe 5 contracts there on the position. It's up to $465. So he's got a $90 profit now for one contract. His $450 is related to probably 5 contracts. Well, let's edit that right now. Just make it look as we know. So if I'm tracking a position in the portfolio, I've entered it up here by selecting long stock or long call, married put, whatever strategy you entered, but I put in a wrong value. Then what I'd want to do is just use the More Information button here next to our AMD long call position. I'm going to go to Position Actions and just edit position very quickly. Here I can change the price. Here I can change the date. Let's just change the quantity to 5. So that'll be that 450 that's there. Okay. So now that we know that on that situation. Okay. So the first thing I'm going to do when I'm tracking any position, and remember, we're talking about the expectations here where we feel the stock could hit 15. It's at 14.30 right now. The concern is if it pulls back. Well, there's 2 things I'm going to do right away. The first thing is when I'm tracking any position in the portfolio, I'm going to go to Position Actions and then Position Analysis, even if it's just a long stock. This is going to give me a breakdown of my current position, whether it's an options trade or whether it's just a straight stock trade. This is going to do that to me again, isn't it? There we go. Hold on one second. Now, in any case, we know what a long stock chart looks like. So we see the original position value of 40,770, the current liquidation value after 31 days, 1437, of course, for a 5.7% profit. And now we see some rollout opportunities, and this was a suggestion that came in from Sam. Okay, so he says, well, we could sell the 15 strike calls on it, depending on your time frame. We could go out to July. You see here the new potential return if assigned, the new premium we generate, 56 cents. This is for July 20th. We have all these weeklies in between, the July 6th, the 29th of June. 22nd of June 15 is only at 30 cents. Okay, so it's not a lot of premium we're looking at. And then, of course, you have the 1450s as well. Now the stock at 1430. And as he said, the 15 is the strike I would consider too, Sam, because the concern was it might go up to 15 and then pull back. So I don't want to risk selling the 1450 for June 15th or June 22nd, have the stock go to 1480. That'd be a good return if assigned, but if you're planning on staying in it longer, well then maybe we don't want to do that in risk assignments. But the 15 doesn't have a lot of premium unless you go far out in time. So that's one idea, but I don't think it solves exactly what I'd want to do with this position. When I have a long stock that has a gain, and I'm perhaps worried about a pullback, what I'll typically do is go to one of our other signature tools called the insurance tool. I can also access under the married put or under the long collar. And John, if you go to the insurance tool, you can simply put in your stock, your price, and we can look to buy a put or to sell a call or both. I'm going to look to buy a put, and I'm going to start, let's go to October for AMD. Maybe they have expirations in October. Okay. Now what did this tool just do? This tool shows me my unrealized gain on the position up at the top of 5.7%. Okay, so we're looking pretty good there. By purchasing, now of course we have different strikes here, and I'm going to talk about that in a moment. But what we have here is different puts that we could purchase on the position to help lock in some of those gains, everywhere from the 14, which is just slightly out of the money, up to the 19. Now we have an unrealized 5.7% return on the position. By buying the put at 19 for $4.93, our cost basis goes up to $18.52, but we're guaranteed to get 19 back, so we have a locked-in profit of 2.6% all the way to October. But this is not the right put to use. It is too deep in the money, and any further adjustments would be difficult to do. It would actually create a bearish position. So I might consider, even though it comes with a negative locked-in profit, meaning I'd have a maximum risk of 2.9%, I'd consider the 15 perhaps. If you're planning on trading it long term, that's important. I would use this as you're planning on staying in AMD for a longer term. Now, if you feel, John, that the stock might move up to 15 but then pull back, that it's extended it, you're trying to maximize the return but don't plan on being in it too long, what I might do then is simply go to August or September. Likely August if it's available. Let's take a look. Yeah, August looks better to me. And the 15 strike put, that target price you had mentioned where the stock might be trading, only comes with now a 0.7% risk. You haven't locked in a profit yet. But for 3 months, 2.5 months now, you've essentially got a locked-in profit or a risk of only 0.7%. Okay? All right, so I'm just going to see here. And then Sam has just commented that he just looked at the see a resistance at 16 in 5 years. So 15 or 1550 will be safe. Okay, well, I'm going to use the 15. Now that I'm in the insurance tool, I've got the number. Let's go to big chart, or let's go to our profit and loss chart. And there's the position now. You've got a 15 put out to August. We have jumped the cost basis up for the 152, but what did this do? This still gives you upside if it moves up, only takes on a risk of 0.7% now. And, well, the risk is only 11 cents, $11. What does that mean? Whatever we just did there to make sure that we can't lose more than 0.7% if we're wrong and there is a pullback, well, I can still sell that call that we were just talking about. Let's even go out just 14 days to June. 15 call is 22 cents. Okay, now I'm going to go ahead and sell that. One contract. And now we have a no-risk trade where you can't lose. Still make 8.3% if the stock's trading at around 15 at June expiration, 15 days away. And if the stock stays below that and the call expires, you could sell a June 29th 15 call for another 22 cents, increase this status to where you have no risk if the stock falls, and you still could have more upside if you don't sell the call, but you can still keep generating premium. So as it pulls back, you're still locking in the gain. Of course, another thing that one could do in this situation, if you're expecting a short-term drop, meaning in the next month or so, maybe you could go cheap. Maybe we could go to July. Maybe we could buy the 14 put. Instead of buying one, I'm going to buy two. All right, so well, you've got 3,000 shares, I know, so this would be buying, you'd buy 2-to-1 ratio. Okay, so for 100 shares, I'd buy 2. We're talking about 60 puts in that case, I realize it. But this doesn't really do what you want. I was hoping for a better look here, but this synthetic sort of straddle position now. You're still long the stock. You can still have further upside. And if it pulls back below 13, you can profit to the downside. You don't sell a call if you do this, all right, because you can, and Sam, I know that you do, but if I sell a call in this situation, I'm going to create a completely bearish position that might have a loss to the upside. And that's probably not what you want. Let's take a look. If I did that June call now for 22 cents at 15, just one though. Okay, I'm not selling twice as many. So I've got 2 puts to lock in. I'm going to sell one here. Okay. And take a look at that profit and loss chart. Yeah, see, this isn't too bad, but if it doesn't go up to 16 as we were talking about, profit there of 102, it was better just doing the put and the short call than doing the 2 puts in the short call. I think it was at 143, 150, I believe. This max profit is deceiving because that's if the stock goes to 0, which is not likely to happen. Okay, but it does give you a no-risk position. The worst case scenario is a gain of about $40 or 2.7%, even if it rocketed up to 18. So in this situation, fear of a pullback, sell the call, as Sam says. I do kind of agree with that, but I'm going to look to use the insurance tool first to try to lock in some profit or get a low risk, depending on how long you're planning on staying in the position. Just put in your stock price, your stock symbol, select the expiration you want. You'll be able to see the locked-in profit, and the negative locked-in profit in this case is a risk. I like this August put here with a 0.7% risk, maybe selling the June 15th call for 22 cents on it, gets you a bulletproof trade with still an 8% profit to the upside if the stock keeps going up to 15. One last thing we need to mention before you do any adjustments on AMD. Always go to the research, take a look. Okay, so the earnings are not coming out till 7/25. It hasn't been confirmed yet, but that's target range. Why is that important? That tells me that I'd probably actually want to use the August put, because if I sell that June 29th call against it, I'm sorry, June 15th call, then maybe the 29th, then maybe the July call, if I get another 60 cents, I'm entering closer to earnings with a no-risk trade. You still got a guaranteed profit to the downside, could still have more upside, might be worth it to stay in it that long through earnings by buying that August put at about the 15 strike, selling those 15 calls against it now, and you might need to manage them, but hoping that they expire. And then you can head actually through this earnings at the end of July with a no-risk trade. And still unlimited upside. I wouldn't have the call open through the earnings, but that would be a perfect place to be. Those are the concepts talked about in radioactive trading and the blueprint, whether you start from scratch or whether you have a position that has an unrealized gain. Now, to keep things quick here, because we've got several questions coming in. Rhajiv, Rose, all of you. I'm going to get to those questions real soon. We do have another question from Khokon that came in via email in addition to looking at this other one. Great idea. This came in from Sam. I was actually going to talk about that with the long call. Sam says your other good choice, John, is to sell half of this now, take the profit. Now you've got 1,500 stocks that you can sell calls against and insure the position because you've pulled out some of the profit in half. And in regards to your long call, that might be an option too. I might sell 2 of those long calls, leave 3 open to reduce the cost basis. What are some of the things that you could do with the long call? Well, exactly what we talked about. Treat this almost like the stock. And I could create a strangle in this case by buying a nearer term, just as we saw, perhaps August put, maybe even the same put, the 14 or the 15 strike, and sell the June 15 calls against it. So I'm creating sort of a strangle, and we sort of already saw that with what the stock looked like, but now I'm creating a strangle with a short call for premium. I don't know if this is going to satisfy your needs, but if your idea is that the stock's going to pull back, put gives you extra protection, the call gives you an extra premium, you have a bulletproof 9.4% gain, anywhere between 15 and 12. But what happens at June 15th if the stock's below 15? The call expires, you still have the strangle. Sell the June 29th again, lower the premium a little bit more. This would go higher. So each time you sell a call and it expires, this little strangle you have is moving up. All right, we're going up this way for a higher profit locked in. And if it falls and pulls back to 13 or below 13, that put's taking over the loss that you might gain on the call that you haven't locked in yet. And also consider selling half of it and doing that. So those are the two things I'd consider with this position, with these positions, because you expect a pullback. So adding a put allows you to maybe lock in some profit or have a very low risk on the position, then sell calls against it to do that as well. Okay, Chris, that was the first step that we were talking about. Oh, did I do buy, buy, buy? I'm sorry. That was the wrong graph. I'm sorry. There we go. Okay, so this is what we were looking at. Similar to what we saw in the long stock. That probably doesn't serve your need, but remember, the idea was you're afraid the stocks might go up to 15 but then pull back. That's the end game, is that you fear it's going to pull back. So that's what I'm looking to. Chris's comment, why not convert the long calls to a spread? Well, sure. Depending on how long you want to stay in it, I could convert it to just a diagonal, just as we talked about selling a call against it on the long stock. Just be a diagonal spread. Could I convert it to a 20/20 bull call debit spread by selling the 15? Yeah, but why would I? Okay? If I've got this long term and I've already got some gain in it, and that's why I mentioned selling half, I don't want to do a bull call spread by selling the 15 call now for January 2020 to create a complete vertical. I don't want to create a vertical, Chris, in this situation, because sure, the profit's great. The risk is drastically reduced, but I don't see these numbers until I typically get within 2 to 3 months to that expiration. That's 2020. This is a spread I'm holding on for a long time. Look at the halfway point, March 27th, 2019. It's about a third of the profit that you'd expect. And that's in 2019. The time value is not going to work on your favor converting this into a vertical right now, okay? Yeah, and Naren came in and says, I'm a novice in options. I've been trading stocks for 3 years. I just learned to hedge my long positions. Absolutely. And the hedging can be by just selling a call based on your expectations. A better protection is to buy a put, even against the long call, if you want to try to lock in some of the unrealized gains that you have and you fear a pullback on the position. Okay, but I would not turn something like this into a vertical spread. Okay. Oh, and Naren says, you know, you're a novice there, but you just learned to hedge your positions. Where would I start? Well, a great place to start is going to the Married Put tab here. Learn how to properly hedge. Talking about converting stocks to married puts. The problems with just selling calls and a covered call strategy long term. If you haven't done so already, take a look at the sketch. And just go to the sketch, or you can go to RadioActiveTrading.com and click Get the Sketch, Naren. It's a free white paper that talks about how to insure stock positions. We're also going to have a few webinars next week. We have several archived webinars on it as well. Okay? All right. I pause the screen. So that's what I'm talking about. That's my opinion on the long calls and the long stock. I look to hedge it with a put first to ensure, lock in some of my profit. Leave the upside open and sell a call, but before I do any adjustment with selling a call, I want to see when the earnings are. For the long call, creating a calendar, as Chris mentioned, is great. I would not convert that to a vertical because the benefits of the vertical you won't realize until you get closer to 2020. Now, let's follow up real quick with his follow-up question. And the follow-up question was, let's say you're very bullish on a stock, Micron, and you want to use call options to profit. How would you decide the best expiration month and the right strike price? Well, I'm going to use a tool already created on PowerOptions called the Long Option Finder. Now, related to that, I had a similar question this week, which many of you might have had before. If you're tracking a stock and you expect to bounce off of a support, or bounce in either direction, what is the best strategy? So I'm expecting an upward bounce on a declining stock. Is it a long call? Is it a bull call debit? A calendar spread we just looked at converting from a profitable long call? A married put? Or maybe even a straddle? Well, the answer to that question is it depends. It all depends on the expectation of the movement and the time frame of the movement. If I'm looking at a position and I think it might gain 2% or so off of a bounce in the next 4 or 5 days, a 2-week out or even 1 week out or 3 week out long call is probably not going to be that good. The time value, whether I'm in the money, at the money, or even if I'm out of the money, is going to be near 1 to maybe 1.5% for an 8 to 10 day trade, maybe 12-day trade, 12 days to expiration. That 2% movement is not enough. Now, if you expect a 5% movement sometime in the next 15 days, 5% movement up or down, a long call or long put may very well outperform all other four. And if you're expecting a 7% move in 30 days, it may also be a long call, but that again depends on the volatility and where these are priced. So the answer to the question, which is the best strategy, depends on the movement you expect and the time frame of the movement. If I'm only expecting a 2% movement in 4 to 5 days, I'm looking at a bull call debit, bull put credit, probably not a straddle, but that's protection in case I'm wrong. I'm not doing a calendar call because I'm so short term. I'm not going to buy a call that's even 4 or 5 or 6 weeks out and sell a near-term call against it because this is my target. I'd be better off with a straight vertical. But if I expect a 5 or 7% move over the next 30 days, a calendar, buying out 60 days, 75 days, 90 days out in time call with selling near-term calls against it to keep hedging against that risk is probably going to outperform doing a bull call debit, bull call debit, bull call debit. Again, but it depends on the quickness of the move, the rate of the move, how big the move is, and the time frame for the move to happen as well. Okay? All right, so that's what we're talking about there as well, okay? Yeah, and Sam says he's got an MU, but he's in a different position. He had a nice trade. He got the 65 puts and got out at 57. But this is just to cover this part of the discussion here with what strategy is the best. It really does depend on your move, and let me show you why. Related to MU, I have, oh shoot, I should have paused first, but it doesn't matter. Let's go back. I don't know where MU is. Let's take a look real quick. Okay, I'm going to go to MU and I'm going to go to chain. It's at 58.74, so it's up 115, about 2% today. That's kind of funny. All right, so the question is, you're very bullish on a stock. How would you decide the best expiration month? Well, I can't decide that for you, but I have a tool, and Sam mentioned he's in Straddle. There is a tool that will help you decide based on what is your very bullish expectation and your time frame for that bullish expectation. I'm going to go to long call. We use a tool called the long option finder. So what is very bullish? Well, very bullish might be, I don't know, a gain of 6 points, a little bit over 10%, let's say in the next 60 days. So we'd be at about $65, $58.74 up to about $65. And let's say I'm just going to dump $1,500 into long calls. Now, I said 60 days. So let's go out to August 1st. Okay? 10% movement somewhere between now and August 1st. What's the best option? In theory, the best option is the August 52.5 call. How do I know that? What this tool did is it went out and looked at every single option available on MU. It grabbed the current price and, of course, some basic data, volume and open interest, but the current price, how many contracts I could buy based on my investment amount, the estimated value of that option if the stock hit my expected target on my expected date, and ordered it from highest percent return to lowest. You can say, wow, with a 10% move, these returns aren't that great. Now, you're right. They look a little bit inflated to me. The 55 call, which is only $3 in the money for a 77-day trade, is $7.25. Okay, so that's half of that is intrinsic, half of that is extrinsic. So that's pretty expensive. And that's a volatility, okay? So the question is, well, why would I pay for something so expensive? Why wouldn't I buy a June or July? Well, because you set a target date of 8/1, right? If the stock doesn't hit until 8/1, the June or July didn't do anything. If your expectation was it was going to move up only 5%, you know, just half of that, about 4 points or so, or I'm sorry, about 3 points, let's say, to go up to 61, and you expected that to happen in mid-June, or right before June expiration, pretty big move, not really. Now we're going to see those options that are shorter in, 14 days out, okay? call it 440. You could buy 3 contracts, the 55 strike, I'm sorry, and that would be a 36% return. You're not seeing maybe as high as returns as you're expecting because this is only a 5% move and because these premiums are still look inflated. Right? This is still about $1.20 extrinsic value for a 15-day trade. And that's why Sam is saying, I'm sorry, he's waiting to sell some MU calls waiting to sell calls and puts next week. Just want to see how the stock performs. Now, I'm not advising that you sell premium because you're very bullish. That's a little bit different, but you can see the premiums are enriched. Sam does have a long straddle, he had mentioned as well. So that's the case there. Okay, that's what we want to do. You want to use the long option finder to see, based on your target and your expected date where the stock might be hitting that target, Jeff, which option would give you the best bang for your buck. And are these accurate? Well, yeah, these are pretty accurate. I selected 614. If my stock was trading at $61 at my June 55 strike would be worth $6 exact intrinsic. So you can't fault that. That's going to be pretty much what it's going to be at that time if the stock hits the target price on the target date. So which call is the best? It depends on your expected movement of the stock. Not only the rate of the movement, percentage-wise or monetary, but also the time frame. That's going to help dictate which option is the best one. This tool is going to help you find it with 3 field entries and 1 click of your mouse. Simple as that. All right, so now I jump back here to the last question via email, and then we're going to jump right into everyone's questions that they've been sending. Okay, so the other question was from Khokon that came in right before the webinar started. And he said, please comment on my recent experience this week, Thursday, towards the end of the day. Each time I encountered a put I wanted to sell, so we're talking about cash secures, naked puts, so stocks with earnings coming out, I found the IV to be very low. I kept seeing it drop, and the premium kept dropping like a rock, even though the stock price was going down towards the end of the day. So you sold the June 1st 96 put LULU at $1. And what strike would have been preferred? Well, let's take a look again at what we're talking about here. I'm going to go to the chain real quick for LULU. I'm sorry, let me bounce right back here. There we go. I'm going to look at the chain for LULU. All right. Okay, I'm going to pause real quick. Naren's been commenting several questions here on sale, but his comment is, he just asked a quick comment, and it's the second time he asked it, sorry. But Naren says, is there any service I can watch your trades and learn for a couple of months? Well, Ernie and I post our RadioActive trades, which are just related to the married puts at RadioActiveTrading.com for Fusion subscribers. Okay, it's only related to the married put strategy. Other strategies I trade in my personal portfolio are shown there. And of course, you mentioned that you want to see how you've been screening options and risk reward. That's available on PowerOptions for the different strategies. So everything I'm talking about here, Naren, when we talk about naked puts and covered calls, bull put credit spreads, and so forth, those are the tools we support, and there's a search for each one. And for covered calls and naked puts, there's picks of the day and monthly picks of the day, and bull put credits and calendars, there's default searches in the search. Why am I mentioning that? It's because those are the criteria that Ernie and I would use as a starting point to create our own positions in those strategies, and we might make subtle adjustments based on that as well. Okay? All right. So I just wanted to mention that real quick. That's what your starting point is. If you're interested in other strategies beyond married puts, then I would seriously consider looking at PowerOptions and then using those searches. Here's the jump in LULU today, 17.14. Okay? And the question was, looking back at the historical chain, well, we're looking at the chain now. Let's go back one day. Okay? The stock was down 58 cents yesterday. 96 put was about $1 when the stock was trading at 105. The volatility was very high. It was at 1.90, and you said you were worried about it dropping. I hate to say this, but you got a 1% return for one day. I wouldn't fault that. Would these have been better? Yeah, but with the premium, yes, but you didn't know that. There's no way you could have known that. I would never have sold the 102 or the 103 strike at the end of day, at a stock trading at 105 that has earnings coming out, what if this had dropped 17 points the other direction and I had sold the 103 strike at 325? Well, I would have had to buy stock at 103. My cost basis would have been at 100, but we're at a stock at $87. Okay, you were bullish on it. You gave yourself some cushion, but you took that strong chance. You know, when you got down to it, I mean, the probability above from yesterday was all high, you know, based on the movement, but with earnings coming out, essentially throw that out the window. You never know what's going to happen. Sam says, you know, comments, you're lucky that Lulu had good earnings. If you would have straddled, absolutely, you would have made more money. If you had bought a call and bought a put, you know, would have been about $8 or so here. The $17 pop, you would have made 100% profit, I guess, on the position. And the call and the put, you know, would have been about, well, yeah, it might have been around 860, 870, and now the stock at 117, the 105s would be $12 a piece. Oh, yeah, so I'm sorry. You would have made a 50% profit, I'm sorry, in that direction. And never sell premium going into an earnings in this case. Volatility-wise, I'm not even going to compare them because that was all based on earnings, and then you had the volatility crush today. Your main question, Khokon, was why was the premium dropping as you were getting towards the end of the day, even though the stock price was going down? Well, it's probably because the volatility was ebbing as the market was, and it wasn't just because of it wasn't just because that, you know, you think earnings are coming out and you're getting closer to the hour of earnings that implied volatility should be going up. There's also implied volatility in its positions related to the market, not just the earnings. And as the market had a good day yesterday, we saw the VIX pull back. Okay, I had a good return on those VIX calls. You know, I closed those out this week. We talked about that last week's in Sam, the positions in UVXY that Sam does. There's no way to tell which one would have been better, and I never would have done this personally. That's the best way that I can answer this, Khokon, because selling a naked put naturally takes the risk to the downside. Your position worked out very well, and you had a very good return for a one-day trade. You can look back all the time and say, oh, well, I could have sold the 103 or the 104 and done fantastic. Yes, you could have. Hindsight is 20/20. You could have also lost more if it moved in the opposite direction. Okay, so that's my concern there. Which one you had mentioned? You said you were overly conservative with your strike. Well, selling a naked put before earnings to me is not conservative. Even though you went out of the money and tried to get that 99% probability, when it comes to earnings reports, Khokon, when it comes to earnings coming out, throw the probability out the window because you don't know. There's no way to know. The probability can't factor that in. Remember, the probability values and even the delta, if you have a delta of close to 1, that's all based on the past movement of the stock with some eye to the current implied volatility on power options. Other websites don't do that. They just look at the past 50-day or 60-day volatility to calculate delta and perhaps probability as well. So it's based on what's happened in the past, not the event that's coming up in the next day. We do factor in the implied volatility, which would have taken into account that strong rise at 1 point or 190% implied volatility or 200% implied volatility on LULU. But again, you got to throw that out the window when you're going to earnings because you don't know what could happen. That's why buying a straddle or buying a strangle, even though you suffer the volatility crush, might be a better approach long term than taking the chance of selling high premium or doing a short straddle or short strangle going into earnings, because one of those losses you hit with that big 15, 20, 25% gain on the stock is going to cost you a 70, 80, 90% loss or more. You're probably going to wipe out 10 or 12 previous naked puts or 10 or 12 previous short strangles going into earnings with that effect. Okay, so selling premium is not always the best idea when you're around earnings. I can't comment on which strike would have been in the best case in that situation because there's no way we can gauge the data, right? Because it's all that those probabilities, the deltas and everything, if you're using deltas as probabilities, is all based on that other realm. It's all based on the past. Okay. Okay, Rhajiv, I don't think I still have it, but let's try and take a look. Rhajiv says this is the first question that came in live, so I do have Rose's questions still coming up. I have a lot of other questions coming in here, and we're going to get to those right now. Rajiv's question was related to the Intel radioactive position. He bought stock around 52.30. He's got a put at 57.5 and also a call at 55. Sold at 55 and bought a 57.5 call with June expiration. Now I'm just going to go back to our May 25th. Yeah, I don't have Intel in there right now. Let me see. Let me see if I put it into the radioactive one. Now there's there's the married put on AMD that we did. Okay, I don't have it. All right, so we're going to have to build this on the fly. So let's just put in Intel. And I'm going to put in just 100 shares at 52.30. And you have a 57.5 put, but I forget where it is. I can't remember what month. I'm going to do September. And we're going to put that in at, let's say, $5. I don't know what price you got it at. Let's see, is that a good risk for us? Okay, so there was the, nope, terrible risk. No, it's a great risk, but I think he paid higher. Let's go to 6. I don't remember his numbers here. Well, it's a 1.4%. I remember he legged into this and got the 57.5 afterwards. So I'm going to put it here. But with the stock at 57.08, he has sold a 55 call for June, which, yeah, it's a gamble right now. Don't know what the premium, and bought a 57.5. So he's actually got sort of a reverse spread that I would do. So I'm not going to go through this, Rhajiv, too much, but here's the question. What have you done here? You have a married put with a bear call credit spread, income method number 6. I don't know what your numbers are, but it's still looking pretty good. Depending on what your outlook is, if you think in the next 15 days the stock could move higher, meaning it could go to 58 or 59, you may consider buying to close the 55 and selling to open a 59 or maybe a 60. Convert the bear call to a bull call debit. This will be done at a price. It'll add to the cost basis of the position. But anyway, if you want to stay in this position, you're going to have to buy back that 55 call. Okay, so your question was, should you wait to June expiration or manage it now? It depends on what your expectation is. If you think this stock's going to continue up, it's probably better to manage that short call now. But you know what? You can leave the long call open if you think it's going to continue up. Or just take them both off the table now. It'll cost you maybe about $1.70 to close the position, because these are the current prices. You know, it costs you $2.40 to buy it back. You get 77 cents back. So you pay a debit of $1.70, but the stock has moved up more. And though you're paying a debit of $1.70, you also still keep the initial credit, so you might only have a loss of $1.20, $1.10, or whatever it is. Okay, if you wait until expiration, oh, I'm sorry, you said you got 90 cents. Okay, so it'd be only 80-cent loss to roll it in this position. I think that'd be okay to do. If you think it's going to pull back in the next 14 days, then that's okay too. You'll leave it open. You'll lose any value you still have in the long call, but this might be cheaper to buy back. So it's depending on your expectations. If you think it's going to pull back, it's okay to leave it open. If you think it's going to continue up, you might want to consider rolling this call, rolling the 55, and selling a higher strike call. And then if it keeps going up, you would be looking with a bull call debit spread near full profit or more. But if you think it's going to also just move up a little bit, it wouldn't hurt to exit that now and then look for a new position to adjust later on. All right, now we're going to get to Rose. Build Rose's question on the fly here. So Rose says, help, how can I manage this position? June, okay. Oh boy, we're in a calendar, I think. I'm sorry, we're in an iron condor for June 29th on the cubes. Looks like what we've done here, June 29th, weekly and quarter 2, because it expires on a Friday. All right, so you've done 3 contracts of this, but you sold the 170, bought the 173, and you sold the 150, bought the 147. Okay, I don't know what you got, but I'm going to just assume. So let's say we sold this for 50 cents, bought this for 10. Okay, 20. And I'm going to keep the same numbers. Sold the 150 put for 50. All right, so now we've got an iron condor position. I'm assuming a 60-cent net credit. You're almost near for loss with Qs at 172.74. And we still have about 29 days to go. All right, so two thoughts on this. Number one, you're near maximum loss. Now, you're not really. This is showing it sort of the halfway point. Excuse me, halfway point. So you may be at a loss of 120 or so on this over a maximum loss of 240. So maybe you're a little bit more than halfway to the full loss. One is do nothing if you expect QQQ to pull back or move down. Okay. Now, you don't have to worry about the bull put side. That's already taken care of for you. What we're looking at here, part of this iron condor that you're in, Rose, is a bear call credit spread, just the 150, 147. So what are some of the opportunities? Well, we could simply close the position and take the loss. You could do nothing expecting a pullback. You could close the position and take the loss. Okay, leave the bull put open, but close it, take the loss, and maybe look for an iron condor or a bear call further out in time to help repair. So close position, roll bear call side. Now you'd have a bear call and a bull put open at two different expirations, but you're not going to be able to repair the loss. You take a loss of 120. What I'm saying is you have 60-cent net credit. If you close this now for loss of around 120, and you keep the 60 cents from the previous position as well, the full profit, but you have a loss of 60, I'm sorry, yeah, I take a loss of 120 now, that's including the 60, my apologies. Now the problem sort of comes into, are you going to be able to find a reasonable out-of-the-money bear call that gets you that $1.10 back? Probably not, but that's an idea. Number three, you could evaluate buying to close the 170 and rolling up to the 172. Okay, so roll just the short. Now, that's going to cost you a debit and lower the return, but if the stock pulls back a little bit, the ETF, I should say, moves back to 171, you still might have a small profit here with all four legs expiring worthless. So roll just the short call. Okay, you might be able to do something called the pendulum adjustment by rolling the 173 call down to, let's say, the 167. So now you'd have two bullish spreads in that case. Okay, but if the stock stays above 170 now, and this will lower the overall return as well, but you'd also have a double bullish position. Look more like that. Now the risk there is, of course, if it pulls back. So there are multiple ways to do this. So Rose, what I'm going to say is if you can this weekend, go to the webinars page, and Nevin, this is a great place for you to start too. Under the option strategies, there's a webinar here, of course, on managing your spread positions. It's not talking about iron condors, but you can start to evaluate the ways that you might be able to adjust just the bear call side based on what your expectation is for QQQ. Again, you've got 15 days. If you think it's going to pull back, you might just want to leave it open. Do nothing, wait to see what happens. You could roll the entire bear call spread, leaving the bull put where it is, to try to give yourself more room and more cushion, but that would be done at a debit. It would lower the return that you were originally expecting. There are ways that you can adjust one or two legs of those bear calls to almost create a bullish position via what's called the pendulum adjustment or just converting it to a different spread. But now you'd have two bullish spreads open. I'm not sure if that's what you want. Okay, but take a look at managing your spread positions. Also on our YouTube channel, there's a quick video that reviews in about a minute and a half the 7 ways to manage a bear call spread. So you want to take a look at that as well. So based on your expectations, and you can send me an email next week, in that case, with the specifics. Okay, you got $1.19 is what you got. Okay, but you can send me an email with the specifics next week, starting on Monday, once we see how it goes, and in that case, we could do that. Okay. And Sam, related to Intel, says you could buy 60 puts if you think Intel is going to go back. That's another issue there, or using a bull put spread. Now, Richard made a comment. Oh, shoot. I'm sorry, folks. Give me 1 second. Richard made a comment, and he says you could buy an SPX option to get out of QQQ. Don't know if that would help. I mean, if this thing's still going up, I mean, Rose is might be near the maximum loss of the position, Richard, I'm sorry. But again, buying an option on SPX does not counter the obligation of the QQQ bear call that might be near full loss in 15 days. It doesn't help with the obligations. It puts more money into the position where if, yes, it keeps going up, Rosie's right. You're profiting on something else there that's going to give you upside while you hit the maximum loss here. But the risk then, of course, is if it pulls back, this goes down in price. But now your Iron Condor is successful. What about the money you paid on that option as well? I like to keep it in the family to keep it simple. I don't like buying alternative things or going, let's say buying long, Richard, the 2 times short QQQ or the 3 times short QQQ or the 2 times bull QQQ, which it would be considered in this case, to try to hedge further losses if it continues up. So I think right now we actually, Rose, have to wait till next week anyway to see what happens in the first couple of days there, and but then we can take a look at it. But we've got 15 days. We want to see if there's a pullback, but the advantage of it now is if you roll it now, you haven't taken the full loss yet, but after this weekend, this number is going to start getting closer to this maximum loss as you're getting closer to 173. So start losing that time premium and having it go against us. Okay, all right. So that's what we might see there, and that might not, it's manageable. It's not lost yet, but it's manageable. We'll take a look there as well to see where we can go. Okay, so that being said, check out the webinar there on managing a spreads position. I'll be honest with you, Mark. Mark's asking a question about the portfolio. And in normal cases, whenever I mention I'm tracking a position, I can link to the position analysis view and see rollout opportunities for my positions as well. And okay, that's back up where I want it to. And there's that calendar spread that I forgot to expire last week when we were talking about it, the diagonal. But Sam, Mark's question is, if I have what he calls a campaign on an underlying stock and he's running the wheel. So what I think this means is that Mark has some underlying stock and he's selling calls, selling puts, buying calls, buying puts, protecting, insuring, generating premium, moving it, and he's doing different things. Letting assignment happen sometimes, rolling other times, reinvesting the assignment, and so forth. He says, how hard is it to sum up the PowerOptions portfolio on a multi-part campaign, in and out of stock, put and call? The only view that would give you a great analysis of that is here in the analysis view. As I close legs, roll legs, close stock, roll legs, it's going to keep me a running tab over the entire position. I fear, because I've never done this in the portfolio, but I know that if you opened 3,000 shares of stock and sold 20 calls at this strike and 20 calls at this strike, but you didn't separate them out that way, and then you assigned 10 calls at one time and 10 calls at another, then bought more shares and you edited the position mark for the maximum return, and then you got assigned again on another 10. This view would not be giving you an accurate effective cost per share, I don't think, because it won't totally tabulate a partial close on the stock until the other remaining legs that were opened initially with that one are closed, because it was never designed with that in mind. It was never designed for, it can handle adding new shares, it can handle averaging new share cost basis and things of that nature. But as far as legging into stocks at different times, rolling down, rolling up, moving back and forth, adding new shares on top of old shares, but then getting assigned on some of the old and some of the new, it's not really designed to handle that as well as you might need it to. I'm just going to be honest with you. But again, I've never done it that way. I just know that if I open 3,000 shares and open 2 different calls against it, I would treat that in the portfolio as 2 separate trades. So if one got assigned and one expired, then I might sort of manually merge them together with an updated price later. Okay? But then again, if you are planning on selling different blocks at different times and at different strike prices for the same expiration, if you got assigned on all of them at different strikes, it would handle it okay. But if you're getting assigned on some, and some of them were the old, and then you're adding new in, you might not get the total that you want to see, or the total effective cost per share you're expecting to see in that case, until all of the olds are closed. It's kind of confusing, I understand, but I don't think it's going to handle that type of strategy very well in this, because of that factor, because the partial closes on the original shares or even new shares might not handle it. Henry asks, what time is the end of the day subscription updated? Am I on end of day right now? I think I am for our webinar view. No, I'm 20-minute delayed, but I think this would have been the time. The end of day data probably would have updated at about 4:40 to 4:50, Henry. All right, so for those $40 per month end of day data, I think it updates at 4:40 to 4:50 p.m. Eastern time. Okay. All right. So of course the different levels of service. There's the. Let's just do that real quick, even though we do it there. The end of day data is $40 per month. Again, it'll update at around 4:50 to 4:41. 20-minute delayed is $60 per month. Still gives you access to all the tools, but with 20-minute delayed. The historical service gives you access to the back testing with 20-minute delayed. And of course, we do offer the real time at $120 a month. So every time you refresh, every time you refresh a search or a chain, you're getting the numbers and calculations at that very instant. Since the Friday webinar is at 4:30 p.m., I typically don't have our webinar account on real time during the Friday sessions, and it would convert over to 20-minute delayed anyway. They're all updated at the same time. So that's why we're not seeing the real time, but on the 12 noon webinars, I usually have real time up and going. Okay. All right. Okay, I'm sorry. Sam had mentioned other positions. I hadn't looked at that one in a while. Sam had just commented, AAOI is my low price stock from 30 this week. It was huge for me. 30 calls in 4 months to go. So he's been in AAOI, and of course, he's excited because he's been using the that new app, the Robinhood investing app. I think they're out of California, if I'm not mistaken, where the online app for buying and selling doesn't have any commissions. Okay, the AAOI is at the 4502. Okay, not a great day today, but yep, there's your run. Now let's go to 1 month. But there's your 1 month run we're taking a look at there on AAOI. And the new positions, to answer Noreen's question, I guess there's your run. Yeah, pretty good move, just settling down. But again, it's probably going to pull back up. Oh, I didn't enter it here, did I? Sorry, I opened another married put this week, actually. So in addition to Canada Goose, Interactive Brokers, Polte, Sony position, sorry, we opened a new RadioActive Trade this week. Why can't I remember what it was? I was just about to do an income method on it too. Okay, let's sign in here. All right, so hold on 1 second. Let's go to, I didn't update the webinar portfolio. It is on my real PowerOptions portfolio, and of course it's on Fusion, which we're going to take a look at right now. And on my Fusion subscription, open trades, OLLIs, that's what it was, OLLI. Good risk on this position too. We got in the stock at 70.85 and got the January 75 put for 9.10 for a risk of 6.2%. And earnings are coming out in 5 days on the 6th. So that was a pretty interesting trade there on that position. Okay. Now going back to something we were talking about earlier with Naren. They were looking at sale. They have a cost basis on sale of $25.10, and you're trying to sell the September 30 against these shares. Even though they own it off of monthlies, that's a 145, 180. But one thing we want to consider, let's go to the chain to sale, Naren. This is something that you might want to consider. And of course, you're interested in covered calls. Go to the covered calls page, and you can see some information on finding weekly covered calls, best covered call strike price. We did a 2-minute video on that recently as well. Some covered call examples. Why am I bringing that up? Well, I'm going to use the custom spread tool here for a moment. And I think you said your cost basis was about $25.30, and I'm just going to use 100 shares on this. And you said you're trying to sell the Septembers. Okay, well, there's nothing wrong with that if it matches your goals. But I want to point out something. You were trying to get the 30 call, maybe 160. Midpoint is about 160. 163. I probably would go 160, and that's a real good return, even though it's out of the money. But okay, there we go. All right. Okay, sorry. Reason why I'm asking this is Narin's comments earlier were related to just getting started, what should I do? In general, when I'm selling a call, even if your outlook is at September, you think the stock would be above 30, you probably don't have a lot of strike selections here. That's the reason why. But with a stock at 25.85, this isn't going to do us justice here. But I'd be tempted to go with the July for only 45 cents. Why? September is at 160. Let's say the worst case scenario happens, okay? And the stock stays exactly where it is right now, and the implied volatility doesn't change. Well, this is actually very interesting. Now that I've said all this, Naren, I think this is the perfect strike to select for your situation. I do have several stocks in the 30, or a couple stocks in the $30 and $40 range that are only monthlies and only offer the 5 strike point differences. Interactive Brokers is one of them. It's a little bit higher price, but some days I'm just dying for a 72.5 strike or a 77.5 strike to do other adjustments, and I just have the 70 and the 75. Yes, I could move on from it to a better stock that has that, but I can't complain on Interactive Brokers' performance from 69 up to 81, and now it's back down to 72, but we've been making money both directions on that position. But in any case, normally what you'd see is that if you sell month by month by month, you'll get a better premium than selling 3 months out in time. That's the nature of options. The option that's 5 or 6 months out in time is not 5 or 6 times the cost. It's usually better to sell month by month. Now that I'm seeing this, I would expect that if you sold the July, you might get 53 cents. And if it expired and the stock was around the same price, you could sell the August for 53 cents and then still sell the September for 53 cents. But that doesn't cut it. That's only about $1.56. You're doing better by selling the September. So I'm going to take back what I said in this case. Now, why is that? I'm assuming the earnings are coming up after July expiration. That's my guess. And that's why the June and Julys, well, actually the Junes are so cheap because they're out of the money. But let me go to stock research. Oh, earnings worse. They're not until 8/8. Okay. So that's still far enough away. But if the earnings were before July, or if there were no earnings between now and September, that's what you'd see. I'm going to take my example for you real quick to illustrate this. It's just the nature of options. It's just the way things are. Is it same strike, same stock? The option that's 6 months out in time is not going to be 6 times the cost, meaning when you're selling, in general, you want to sell month by month by month. When you're buying, you typically want to buy 4 or 5 months out in time. Even though it's more expensive, it's less expense per day. It's less extrinsic value per day. All right, so on Interactive Brokers, 14 days out, our 75 strike is at 50 cents. Let's just go all expirations, okay? So 14 days out, 75 is at 50 cents. 49 days out, it's at 175, okay? So this is roughly 4 times the amount of time. Roughly 4 times the amount of time, but it's not quite 4 times the cost. It's right close to it, okay? So 14 to 49 days. Now, 112 days out, this is at, let's call it 195. And then 112 days out, the September's at 320. Well, you'd expect it to be double due to time, right? So if this is midpoint of 190, let's call it, for 50 days, 100 days out should be at least 380. 112 days out should probably be 390 or 4. It's only 320 to 330. I go out to December. 4 times the amount out in time as the Julys, which are 50 days away, let's call it. So we go to December 4 times the amount of time. This is not this is not $7. No, it is, actually. It is almost 4 times the amount of time. I'm sorry. But in general, when you see this kind of pattern, what you see is if you could do it and sell every 30 days out in time after 90 days, you'd have a much higher premium than just selling the 90 or 112 day out right now. So that's when you do calendars. When you buy, you want to be 3 or 4 months out in time and then selling week by week or every 2 weeks or every month against it going further out. Okay, that's kind of the idea. All right, going back to Rose's, nope, didn't have it there anymore. Get out of this, some of this. Going back to Rose's Iron Condor real quick. Sam says he has a similar situation in an Apple Iron Condor. He tell you he bought the 10 calls in Apple out of the gate and almost got the spread margin back. Okay, so what Sam is saying there, Rose, is just what Richard was talking about. Richard was talking about using SPY or SPX, long calls. So if the market continues up, this SPY, S&P 500, SPX long call is hedging a loss you're taking here. Sam said what he did is he had an Iron Condor on AAPL, and today he bought calls somewhere almost like a ratio spread. He bought more calls on Apple, so when Apple spiked today, it started to counter the loss that he was taking on the Iron Condor because he now has almost a ratio call Condor structure. So let's say, for example, if I'm afraid that this is going to, that QQQ is going to continue up, we could buy a further out of the money, maybe 175 call. It's going to add to the cost basis. It's going to change the dynamic of the trade. I might be going too far out, as Sam said. But see, now what's interesting, yeah, I wouldn't do it this way. Only because if it pulls back, you lose on that long call, and you're not back at profit. I know this, Sam, I know you wouldn't have done it that way, but that's what I'm worried about with Rose's position. If she buys this out of the money call and the stock doesn't move up, and it's got to move up to 178 now, yeah, that's not a good move in this case. It's just because of the premiums, really. And her position was different. She said she got closer to 119 on the spreads before this, that she had 119 where I only had about 60 cents. She had almost double the net credit. So that might actually work. So let's double this. Instead of 30 cents, we're going to make 60 cents. Yeah. And if we bought that out of the money extra call, it's not that good though. If it goes back to the normal range below that 172 area, it's a profit of $249. Okay, but it still has to go up to 177.18 or higher. So I don't know if that's the right strike to use in this case, Sam. Not to say yours wasn't. I think yours turned out really, really good. But I'm just saying that I don't know if this works for Rose's position. She might have to buy something in between, which would be really expensive, wouldn't it? So we bought the 172. You know, she sold the 170 call, bought the 173. She now bought the 172. That gives her a better lower upper break even at 175, but now it's back to the loss there, and I don't want that. Because if it goes back the way she wants, she could still maybe make a profit on the Iron Condor. She's got to be careful with that extra long call if it doesn't do what she wants. Almost call this the Loch Ness Monster trade, huh? Anyway. Okay, Mark says, you do debit calls or debit call spreads on VIX now and then, only if it's above 25. Okay? I typically just buy the calls on the VIX when it's below 13, and that's what I did a few weeks ago. For the volatility index, the VIX is what we're talking about here. And, you know, Sam plays with UVXY, of course, does other positions of that nature. But what I've done in the past, you know, when I saw a lot of hesitation here, we had little spikes, believe it or not. I mean, all the way in November, December, we had these little hits up to 15. And when I saw it pull back to about 11, I would usually buy a new VIX call. And it was at 12. Now my target's around 13, the way we've been. If I see it drop below 13, which we, you know, were back here recently, we dropped down to 13. I bought calls there. I got out of them a day late. Got out of them there. But now that we're pulling back down 13.46, if this hits 13.20 or 13.30, I'm probably going to buy calls on it again because I want to take this. I don't want to cap it with a vertical spread. And I'm not saying this is going to happen again. Sorry, folks. I'm not saying that this spike in the VIX is going to happen again. What I'm saying is that if you're looking for this movement to hedge your portfolio in the worst case scenario, this is, remember, that February 5th to 9th volatility spike. Here is the March 20th to April 5th trade war fear, tariff fear. Here's some more volatility here in April that actually I missed out on. This didn't go too far below 15, so I never bought new calls after I made the profit on this one. I missed this run, but I did get some here, kind of got a profit here, got some in this area, big profit there. I see this hit 13.20. I'm buying a call. And the reason why, Mark, is because if I had bought my debit spread here and in this spike, I made a good profit on the debit spread, but this was almost $8,000 on investing $300 when that happened. A little bit of luck involved, and it was a scary market condition, but it countered, because I had just the long call, it countered the loss I took on my bull put credit spreads on standard stocks, and the loss I would have taken on a diagonal spread for that month's cycle. So February 5th to 9th, I did lose on 2 bull put credit spreads, but the gain on the VIX calls I had more than took care of that for me. Now, that being said, when this is up here, I'm not buying new calls at this point, and as I mentioned, I didn't buy calls here, and I did buy calls there, but I didn't buy calls here. But when it's up this high, above 25, really above 30, I might consider a bear call credit spread. Because you can't buy a put when the VIX is this high because they're now too expensive, right? I can't buy an out-of-the-money put because they're too expensive. But I can take advantage of this by using a bear call spread on the VIX, perhaps. Okay, but when it's down here like this, that's when I want to buy calls, because if there is something bad that happens in the market, I want to let this run. I don't want to have a vertical bull call spread on the position. And I only trade the VIX as a hedge for my total portfolio, Mark. That's probably the other difference. I don't trade it as a single strategy to continually profit, as some investors would do, just trading bull puts on SPY and things of that nature. I don't use the VIX that way. I actually only buy maybe 3 to 4, sometimes maybe 6 calls at a time on the VIX. And when when it's below 13, I'm probably buying 16 strikes 1 month out that are running 30 or 40 cents at the most. Okay, so I'm buying out of the money ones, so in case there is that market flip, I get a very high return. All right. Okay, Sam just said his Apple trade was a day trade. Oh, plus you have 2 extra calls now for 14 days. I see what you did. Okay, all right. Okay, and that is a great point that we should get to in just a moment. I didn't even think about that. We're going to have to take a look at that for you, Rose, in 1 second, but let me get to Richard. Due to unstable markets, would buy-sell bonds on option due to tariffs, I think you're asking? Well, I mean, you can. It's not what I do. I don't play the bond market. I don't try to play options on the Treasury, planning on effect of a trade war or tariffs. What I'm mainly doing right now, Richard, is not looking at a whole new strategy based on what the market's doing. I'm looking on managing the 5 or 6 married puts, the 3 or 4 collars, the 2 or 3 diagonal spreads I have open right now, the 3 actually diagonal spreads I have open right now, the 3 bull puts and the 2 straddles for earnings. So I'm not looking forward going to try to play bonds now, or try to play oil again, or try to do something specific with the markets moving. I'm managing my positions with an eye to the fact that we're in a market which I have been starting to call the headline news market, and others have been we've been doing it since the beginning of the year, the beginning of last year. But it's the headline news market, meaning anything that comes out can cause a market swing, whether it's accurate, whether it's not accurate, whether it's an overreaction, or whether it's an underreaction, believe it or not. And things of that nature you can't see in a chart, and you can't plan for in the sense of saying, hey, I'm really bullish on this stock, but I think in 3 weeks something strange is going to happen overseas and we're going to see a spike in volatility again. So I'm going to buy the stock for a long-term gain, but right now I'm going to do a double straddle inside the stock position and sell a call against it to generate premium so that I can profit on the downside with the straddle short term, adjust the straddle into a broken wing butterfly, while 5 months down the road I'm still bullish on the stock. I like to keep it simple. That's too convoluted for me. So I keep it simple with my positions, hedging them with the put options as we showed at the beginning to protect stocks that have a gain. Normally I'm just buying married puts from the outset, following the radioactive trading techniques and what's discussed, of course, in the blueprint there, the full book that describes the married puts, the protected radioactive trading positions. But as Naren also mentioned earlier, I trade bull puts, and I trade it based off of the bull put weekly default search that we did the historical testing on. I don't do covered calls and naked puts, honestly, and I missed out using the picks of the day, which were very profitable. But I missed out on using the picks of the day for covered calls and naked puts, from 2017 to 2018. But I also missed out on the losses I would have taken in February and in March with those two volatility shifts with having a covered call open if I didn't have the proper stop set. I'm just going through the weekly bull put screen here because I have to open some more on Monday. So it'll be interesting to see which ones come up on my list for Monday there on the bull put default screen. Now, Rose has got a great point that I did not even mention. I didn't even consider. In this case, we should have thought about it. I should have thought about it in this sense. But going back to that iron condor, and I think I took away, but the concern now is actually Rose has a good concern, which we forgot to mention, is that she could be assigned any time. And you know what? That might be okay. But if you don't have the capital, and it's 300 shares at 172, you'll end up being short shares of stock, Rose, for the short call if you get assigned. Because your broker won't assign that 173 call. They won't exercise it automatically unless the stock is trading above it. Okay? But everyone's still probably waiting to see what's going to happen there going forward. Okay? But yes, early assignment is a concern. And if you are really worried about early assignment, I would suggest closing the position early next week because you said that happened to you on TLT this morning, though it expires in 6:15 yen. If you want to avoid the assignment on QQQ, I'd look to adjust that bear call further out to give you more cushion out in time and up in strikes as well. Okay. Richard, I'm sorry, I don't understand your question. You said, will dividends buy, sells, options, and stocks to receive dividend payout 1 month out? If I buy a stock today and I sell a call, and tomorrow the ex-dividend date, or Monday is the ex-dividend date, and of course the call is still out of the money and I'm not assigned, as long as I'm on record of holding the stock, I get the dividend. But if you're just buying and selling options, no, you don't have to pay a dividend. I'm not sure that's what you're asking. But if you own the stock and you're doing a married put or a collar, you still receive the dividend. Even if you sell a call against it, that doesn't cancel the dividend. If you're just buying options, you don't have to pay or you don't collect on the dividend. Okay. All right, going back to the VIX, Mark says, yeah, on the right on the peak down, you'll do that with a bear call spread. That's what I look at for VIX too. Okay. All right, well, we're not going to have the time to do this. I'm just going to answer this very quickly for Rhajiv. Rhajiv came back in. So, Rhajiv, I'm not cutting you short. You'll be able to watch it on the webinar, but I'll review it real quick. But you did ask this other question. You said how to create a position on U.S. Steel or AKS Steel, sell a put or create a married put due to the tariffs, medium or long term. I just went through that discussion about how I'm not trying to play the market, play the tariffs or anything else. I'm managing the positions I'm in. I'm keeping with the patterns that I'm in, and I'm not trying to overplay the market based on news that's coming out, geopolitical, or how it could affect steel, aluminum, German car makers, unfortunately. I like German cars. I own one. But that whole discussion this week kind of made me sad that, there was talk about not wanting German cars on the U.S. highways and putting tariffs on them because it's an unfair trade balance. Okay, I understand the math on it, but I like my German car. Long story short, you know what I'm going to answer this, Rhajiv. I would open a married put because you don't know. You don't know how the tariffs are going to affect it. So a married put, I'm investing capital. I've got a low risk of 5 or 6%. So if I'm wrong and it's not actually a bullish effect and it drops, I'm only losing 2 or 3%. The risk of doing a naked put, obligating yourself to buy shares of stock, short or long term, is that if you're wrong in the short term and the gap down is more than you expected, 8, 10, or 12%, your 1 week out naked puts could have a severe loss on it and require much more active management going forward. I wouldn't do that. So if you're trying to play market on news that could or could not come to fruition, that could really benefit American steel or benefit it slightly, depending on how the market reacts, I'm going with a limited risk married put position every time, because there's so much out there that in theory we could say all of this is going to be good for U.S. Steel or AKS Steel. All of this points to bullish and they should be really strong. But it could not come to fruition. It could not be as large of numbers that have been talked about as far as tariff goes. It could be a third or half of that. You don't know. And because I don't know the future, I don't try to chase the news and the newest trend. But if I do want to take a flyer on something, I make sure it's protected and it's not in a naked put or short strangle where I have uneven risk to either side. And that's the best way I can answer that question along with AKS. Now, on your bear call, we talked about that. You'll be able to see it in the archive. The thing is, again, if you don't want to be assigned early, just as we talked about with Rose, that is a concern with the QQQ position that she's in, where she's short the 170 call and the 173. Rose, again, let's see how this happens on Monday, how that plays out. We'll see where QQQ stands on Monday, if we get a pullback or not. If it goes above both strikes, then we're going to consider doing an adjustment, and we'll talk about that on Monday or Tuesday if I get a chance to email you or talk to you. But with your bear call, if you're really worried about being assigned early for whatever reason, Rhajiv, I would close out the bear call now. And I might do it also, I might just roll this 55 up to the 58 or the 59 if you think it's still bullish. See, the management comes down to what you think is going to happen, not what's, hey, this is the strategy, this is what I did in this married put, what do I do to fix it? Well, it also has to come down on what you're expecting to happen. If you expect it to pull back or remain neutral, I'd leave it open, but you're still risking early assignment. If you think it's going to continue up, I would close that bear call as it exists now and maybe move it to a different one or just sell a higher strike call. Sam had some good comments during that conversation, which when I post the archive this weekend or on Monday, you'll be able to go back and look at that as well. Okay, but yeah, that's essentially it as far as that goes. You might be able to do a pendulum adjustment on that bear call spread right now, but that's something that's reserved more for spreads themselves, something Rose could do with her iron condor. I don't think you're going to be able to do it in that case going forward. All right. Well, I don't see any other questions coming in. I'll try to get this process for you as quick as possible, Rhajiv, so maybe I can have it open on Sunday. I'm sorry, posted on Sunday or before Monday's open so you can take a look at it. I'll shoot for Sunday. How about that? I'm sorry, folks. There we go. That's what I wanted to do. My apologies. So yeah, I don't see any questions that have come in, but if anyone does think of any questions later on, of course, remember, you can send me an email at any time. If you haven't tested out Power Options yet, just go to PowerOp.com, put in your name and email address, and we'll start you off with that 14-day free trial. No credit card is needed. At the end, of course, we already showed this earlier, you've got the subscription services, $40 per month for the end of the day. Data is only updated at the close of business. As we mentioned to Henry, only about 450 to 445 or so is when the update comes through. Most popular service is the 20-minute delayed data service at $60 per month. But many of our spread traders, especially if you're looking at 2-week out or 1-week out spreads or less, use the real time. And it benefits them greatly for the real-time prices also. The historical service there, that's an upgrade from the 20-minute delayed where you get access to our back testing tools where we have options data going back to April of 2006. And that's $100 per month. And then the full service, history, real-time, access to the API, the Alternative Programmers interface there, that's $160 per month. We showed this earlier, some of that free stuff. You can take a look at the blog, blog.powerop.com for free education. You can also check us out on Facebook. And as mentioned, you can check out our webinars page at any time, powerup.com/webinars.asp. That is a public page. You don't need to be logged in to reference it. And of course, on YouTube, you can always check us out on YouTube as well. I'm just going to go there real quick and not be signed in. But I mentioned a couple of things there that we talked about. I said I'm not going to sign in. That's right. Hold on one second here. There we go. That's much better. And if sound comes on, I apologize. I think there's something here that's on autoplay that I don't want. There we go. Okay, so where I was going with that is if you can check these out. I've been having some fun with these, and I've got a lot more coming out soon. They're very simple. They're introductory, of course. But here's YouTube, and here's Power Options, of course, PowerUp.com. I'm sorry, YouTube, Power Options. We put together a couple of these videos here. Which is the best covered call strike? It's only a minute and 33 long. And 7 ways to manage a bull put, and 7 ways to manage a bear call credit spread. And you see there's that iron condor view. So Rose, if you're still online, you should check out that link. I'll email you that link. It's just a quick review, 1 minute, 54 seconds there on managing bear call spreads. And that's the side of your iron condor that you need to manage. But related to what is the best call strike price made for Navin, later on you might want to check that one out as well. There's fun little videos, that's all. Nothing really advanced, but good education, just fast. All right. My apologies. Let's go back here. Changing screens too much. There it is. So if anyone needs it, remember, send me an email at any time to support@powerop.com. You, of course, can also reach me at support@radioactivetrading.com. You can call us during market hours and at any time at 302-992-7971. And Rhajiv, I'm sorry I didn't want to go through it again, the discussion we had with your bear call, but I'll get you some other ideas on that too. Ben asks, what is the API? Oh, if you go to PowerOp.com and check out the sitemap, just look for API documentation. It's a programmer's interface. So what you could do is if you have a programmer or you know programming as it relates to what you'd want to do with options, you can create a backdoor program to work directly with our database to pull the data down yourself, where you don't necessarily have to go through the format of the subscription. So you can do a different type of data setup and data query, but it is still limited to just the strategies we support on Power Options and just the data criteria we have. There's no extra data that's there for other technical or fundamental indicators, but the API allows you to sort of write your own computer program to interact with our database and put it in the display that you're looking for. Okay, that's what we've got there. All right. Okay. All right, so you have more questions about that, Ben, again, just go to powerup.com, click on the sitemap, and then there's a link inside the sitemap for the API documentation. That'll probably answer your questions better if you're looking for something along those lines than what I just did. But then give me a call or send me an email over the weekend, and I'll have Greg or one of the other programmers get back to you. Okay, so they'll be able to help you out. Ladies and gentlemen, I think that does it. Happy June 2018. Let's make this a very profitable month as we go through the midway through the year. And we'll have some more videos for you. We'll have some more entertainment. I'll try to get this one up for everyone, including Rhajiv, so he can kind of see the discussion on the bear calls. And I'll even drop him an email, too, if I think of anything else. So thank you, Ben. Have a wonderful weekend as well. Sam, thank you. I'm glad to have you on these presentations with me. Rhajiv, of course, also. Rose, thank you for your questions. And Richard, thanks for your comments related to Rose's situation. And Mark, I'm still not 100% sure on. I got trapped with one of the bear calls on the VIX a couple months ago, so I've done it too, just as you have when we talked. And they usually work very good off the peaks, but you got to catch the peak right, because if you don't, you can lose on the bear call on the VIX when it's supposed to be helping to hedge your other portfolio portions. But no, I've done extremely well with the VIX, but again, I usually just buy the calls when it's at a low point, which I don't always time right. But if there is that spike we saw, I don't want to be doing a vertical because I want as much profit as I can in that unexpected event if the VIX does shoot up again to 25, 26, 30, 35 even, rather than having it capped with a vertical spread. But I think you're playing it right, and I think you're playing it well, and I do love the idea of the bear call spreads after the spike on the VIX or the UVXY. I just don't know about doing the verticals yet if that pays off long term, more than owning a long call does, or buying the out-of-the-money long call on the VIX. Take a look sometime, maybe. If I get some spare time, I'll take a look and run some comparisons there. But anyway, everyone have a fantastic weekend. Take care. We'll see you soon. Good night.